How we doing, everybody? Welcome to the section on premium and discount pricing. So now this is just going to be an overall basic view of the understanding and theory behind premium and discount pricing and how we use it in our trading. Now we will go into it in a lot more detail when we come to supply and demand later on, because this is all a theory based around, supply and demand within the markets, Wyckoff theory, because what we understand and we know in the markets, right, as retail traders such as ourselves, every single one of us, yes, we call ourselves smart money traders and, it's branded as we trade like the banks, but we are still retail traders. We are not, the volume that we put in the markets, our tiny lot sizes equate to nothing of the volume that goes in these forex markets. I think it's about 500 billion in the forex markets a day equates from retail traders, and it's something silly like 95% of it is trillions of it. It's like 5 trillion a day is from the banks, financial institutions, the composite operator. They're the ones with the trillions of capital to move the markets. We do not touch the surface of the volume that goes in the market. So we know that the people who move the markets are the banks and financial institutions, or the composite operator, or the composite man, whatever name you've got for them. They're the ones with the capital who move the markets. They're the ones, it's all it is, right, is the exchanging of buy and sell orders within the market. It's these transactions taking place within the markets that is moving price. Now, the way we've got to think about premium discount pricing, if you've got anything in life, right, let's say you've got your mobile phone. My mobile phone is to the right of me here. If I've got my mobile phone and I bought that mobile phone for £1,000 or $1,000, and I know next week I can sell it for $500, but then if I hold on to it for a month, it's going to go to $2,000. Just say we knew that. When are you going to sell it? You're going to sell it when it's £500 next week, or you're going to sell it when it's at $2,000. You're going to sell it when it's at $2,000, right? And it's the same thing. The same thing applies on the charts, right? We know that in anything in life, if we want to buy something, we want to buy it when it's at its best price, when it's discounted, when it's cheaper. And then we want to sell things when it's at a premium price. We want to sell things when it's at a higher price because we want to make more money. So you'd be stupid if you were to buy things when something was super, super expensive. If you had a car or anything in life that is so expensive and overpriced, you're not going to want to buy it because you're probably going to lose money on it. You want to buy it when it's at its best price and when it's cheap. You want to buy when things are discounted, right? And it's the same thing applies vice versa. So if you wanted to sell something, say you've got something and the price of it is skyrocketed at the minute because there's a lack of supply. Obviously that is how it all works with supply and demand, but there's a lack of supply, so obviously the price of it's gone up. You're not going to buy them when it's super expensive. If you've got it, you're going to sell it because it's at a premium price and it's at a level and a price that's a lot more than what it normally is. And that's the whole thing with supply and demand and premium and discount. Now, how it works on the charts, like I said, is the banks and financial institutions, the people who move these markets, they want to do exactly the same thing. They want to be buying and selling and bringing prices back to cheap or expensive levels. So what we can see here, right, is we've got bullish market structure, okay, on the left-hand side. We know that when we've got bullish market structure, we're putting in higher highs and high lows within the market, okay? We can see we put in a higher high, we pull back, we get breaker structure, and we consistently see these higher highs and high lows being put into the market. And vice versa, when we're bearish, we have lower highs and lower lows being put into the market, okay? Now, what is premium and discount pricing, and how do we understand where these levels are? Because we know, right, if we look at bullish market structure, we know that we expect to see a new higher high, a new higher low, and before a higher high. So how do we draw and identify these premium and discount levels, or these cheap and expensive levels? So what we do is when we've got swing structure, okay, so we can draw on right here a breaker structure, okay? This leaves behind a new protected low in the market. I think we could all understand that. So this at this point in time would be the protected low. Okay, and then what we have is price pushes on and puts in a new higher high. So before we got this break, this would have been a weak high, right? We understand that that is our swing structure, like we went before, like we talked about in previous videos. That is our swing structure, okay? The weak high and the strong low. So all premium discount pricing is the 50% of your swing structure. So what you do is you take your swing low and your swing high, okay, and you draw a Fibonacci tool, okay, which we will show you the configurations for it. So you can see we've got we have three options ticked. We have 0, 0.5, and we have 1. Okay, the top 50% is your premium pricing, and your bottom 50% is your discounted pricing. So how do you identify this on the charts? Well, it's simple. When you have a higher high and a higher low, and they're your swing structural points, all you simply do is you draw this Fibonacci tool from the swing low to the swing high, okay? And all this is now is the top half of the Fibonacci tool is the premium pricing, and the bottom half is the discounted pricing. So like we said before, if price is bullish and they're continuing to push price up and they're continuing to buy, where do they want to buy? Do they want to buy when things are expensive, or do they want to buy things when they're cheap? They want to buy things when things are cheap, right? And that is when price is discounted. So we know discounted pricing is within the bottom 50%. So we see here that this here is the bottom 50%. So ideally, what would we like to see? We'd like to see price pull back, okay? And we'd like to buy within the discounted level, which is below the 50% of the Fibonacci tool, okay? So you know, if you're thinking about trade ideas and you've put in a higher high and you're pulling back and you're trying to buy and to continue to take prices up. If you're buying when price is in premium prices, you're trying to buy when price is super expensive, right? Because the banks and financial institutions, the ones with the money, they want to be buying when things are cheap as well, okay? And it's cheapest for them when they're in a discounted price, which is at the bottom 50% of your swing structure. So we understand that we have the higher high, we pull back, put in a new higher low. The higher low we'd like to see pull back into discount, which is in the bottom 50% of the swing structure. So we can see here we have a swing low to the swing high. Here's the 50%. Price pulls back, and that's what we'd like to buy. So we know any levels that are within the discount, which is in the bottom 50%, are good levels to buy from. So we know if we're trying to buy within premium, we're in a lot more expensive pricing. So we want to be careful buying in premium. It doesn't have to always pull back within it doesn't always have to pull back to discount. You know, this is a stacked confluence that we use, and we'll show you how we use it later on in our trading to really understand. But you know, ideally when you're trading, you want to be buying at a discount, selling at a premium. So it's exactly the same thing. You get a new higher high within the market, we pull back, we put in this new low, which leads to this break of structure. Once again, it's exactly the same thing. Okay, we have this break of structure to the top side. Okay, get this higher high, pull back, higher low, new higher high. We get a new protected low within the market, which is this level right here. Okay, and we get a high high and we start pulling back, right? So this was the protected low, and then this was the weak high. Okay, weak high right here. So all we know, again, how do we identify the premium and discount of this current swing structure? Well, it's simple. We literally go from the swing low or swing high, however you want to go for it, high to low, low to high, and we just draw on a 50% fib tool. Top 50% is premium, bottom percent is discount. So when we know we're bullish, when price is bullish, they're buying. They want to, because obviously we're looking for higher highs and higher lows. We're looking for the highs to get taken, and we're buying because price is going up. So what we want to do is buy within the discount, which is at the bottom 50% of the fib tool. Okay, so we put in the higher high. So when we pull back, ideally when we're looking to buy and continue on the expectation to come and take the weak high in this example, we want to be seeing prices pull back into discounted levels, put in the new higher low before continuing and putting in this new higher high. We want to see that within the discounted level. So once again, let's just say we pull back here like this, okay, and we're looking for buys. We've had now, this is a breaker structure to the top side. This now leaves behind a new protected low within the market, and this would be current structure. We've got a new protected low and we have a weak high such as this. So when price is pulling back and we're looking to buy to continue on with this bullish trend, where are we looking for price to come to, right? We're looking for prices to, sorry, the wrong one. We're looking for price to pull back to the discount, okay? We draw a 50% tool from the swing low to the swing high, and there we have it. So what we're looking for prices to do now is to pull back into the discounted levels of the swing points, which is obviously we always go from the swing low to the swing high. We look for price to pull back into the discounted levels, and they're the levels we'd like to buy from. So any sort of levels that we have in the discount, they're the ones we'd like to buy from, okay? And we'll look and we have exactly the same thing here. There's no difference within bearish market structure, okay? We have these breaker structures to the downside, okay? We have this breaker structure which left behind this protected high within the market at this given point. Protected high, weak low, which was obviously our target. Same thing applies, once again. Let me just draw that one on here. So same thing applies, get a breaker structure to the downside. Sorry, this was the target, sorry, at this given point. So when we're looking for price now to pull back and we're looking to sell this time, where are we looking to sell? Where will people want to sell things when it's super cheap, when it's super expensive? It's going to be when prices are expensive, right? Because you want to be making more money. So you'll be selling when price is in a premium. So that is at the top 50% of the fib tool, which is the range, right? So you can see here, this is the swing high to the swing low, we can see we draw on that 50% range. We draw the 50% fib tool on. We go from the swing high to the swing low, just like that. We can see price then pulls back up into the premium levels before we continue and we sell off. And this is what happens. And that's what we want to be looking for. Like I said, price doesn't have to pull back to the premium and discount every single time. You will get the instances where it won't. But this is what I mean. It's just a stacked confluence, right? And you'll see it more often than not. So, you know, for example, you'd be like, why did I fail here? Or why did this lose? One of the main things might be, oh, I bought at a premium or I sold at a discount, right? And that's something that you might notice, right? And then we'll just go on to this last example here. We can understand that this is a breaker structure, okay, which is left behind this new lower high within the market, okay? This is currently our protected high, not this one. And let's just say now we start pulling back, okay? We start pulling that back. We put in this new week low. Where would we now? We understand that currently with a weak low and a protected high, we are bearish. And then what do we expect to see? We expect to see a new lower high in the market before a new lower low. So what do we expect to see? Well, we'd like to see prices pull back into the premium, right? Which would be in the top 50% levels. So ideally, for price to come into the top 50%, put in a new lower high before it continues to put in a new lower low. So that is the theory behind premium discount pricing. As always, we're going to take it to the charts now and show you actual real life examples of how to plot these on the charts.